Was last Monday the bottom in the stock market? The Dow was down to 18,591 points, wiping out almost all the gains since the 2016 election. The following day, it was up over 2,000 points. So that's gotta be the bottom, right? Man, I am so annoyed that I did not buy in on Monday. Oh, what a tragedy. Hey guys, Credit Shifu here, and today we are going to be talking about finding the bottom in the stock market. It's a huge hot topic that everyone wants to know about. And we're going to also talk about why it really doesn't matter at all, okay? And we're going to give you a strategy that you can use instead of actually trying to pinpoint the exact bottom. So if you don't know, and to be honest, if you don't know, I do not know why you don't know unless you've had your head under a rock for the last few months. But the S&P 500 is down around 29%, give or take, because the market is fluctuating since its 2020 peak, okay? So we are definitely in bear market territory at the moment, guys. If you don't know, a bear market is when stocks are down 20% or more. Contrast that with a correction when stocks are down 10% or more. So two types of drops in the stock market: corrections, 10%, bear markets, 20%, okay? Now, bear markets on average, they last a lot less time than bull markets. I'll put up some statistics on screen, how long a bear market typically lasts, but it is a lot less, a lot shorter than a bull market, going off statistics from the last 100 years. So in a bear market, obviously the hot topic for all investors and analysts, etc., is going to be where is the actual bottom when we're getting a reversal and we're going to start turning around, and everything is going to start rising again. And if we buy in on that bottom, we're going to see massive profits. Now, I made a video a couple of weeks ago called Why I'm Buying Stocks Right Now, okay? And I think some people misunderstood that, meaning that I was going all in on that day, okay? Buying stocks on that day. And that's just totally wrong. I put in about $2,500 on that particular day, but actually the truth is I've been steadily buying stocks for the last 2 weeks. I've put I think it's about $8,000 into the market this month, all right? So, it's been a steady stream. And people were leaving me comments like, this video is not gonna age well. So maybe I should have been more clear about that in the video, that we're going in gradually as the market falls, all right? So my bad, but anyway, that's kind of the score with it. Now, why would the market bottom out, okay? Well, the market bottoms out when certain things are basically already priced into the market, okay? So there's a concept of priced in, and no additional bad news comes, and actually you get some good news, and that starts to bring you out of it, all right? So the reason I kind of am considering this Monday as a candidate for the bottom, okay? Not necessarily the actual bottom, but it's the first time where I thought, yeah, perhaps this is actually a candidate that last Monday may have been the bottom of the market, okay? 18,591 points. And I'll tell you why, and that is this concept of things being priced in, okay? A lot of bad news, I feel, has already been priced into the market. And a really big example of that is this morning, we got the unemployment claims data. It is the biggest in history, over 3 million unemployment claims. However, the Dow continued to rise. It really was not affected by it, and I would say that is probably because it was already priced in. Traders had already, thought about it. They'd already thought, yeah, we're going to get that huge unemployment data. It's going to be around 3 million or so. They priced that into the market, and the market has already dropped considering that data, okay? Now, if it had been 5 million, all right, that would have totally obliterated what had been priced into the market, probably, and it may have dropped, but it wasn't, okay? It was 3 million, it was roughly what they expected. But in addition, you had a lot of good news happening. Yesterday, the stimulus bill passed the Senate. It'll head to the House on Friday. So that is a major piece of good news that is affecting the market. And, the Dow continues to rise. We're up around 22,000 as of today. So way off that low last Monday. If we have additional drops, we've already got quite a big buffer zone before we have to get back to that low. So I think for the first time that Monday may have been the bottom. Don't quote me on this. Don't hold me to it if it doesn't happen, but it is definitely a candidate for the bottom. But now let's look at why timing the exact bottom of the market doesn't really matter, okay? And we'll go back to the 2008-2009 financial crisis. Now, there were actually two bottoms in that crisis. There was kind of a false bottom in November 2008, and then an actual bottom in March 2009, okay? And Motley Fool had an interesting statistic. I'm going to read it out for you, and it's about people who would have bought the second bottom versus the first bottom. So the S&P 500 is up 212% from the first bottom, okay? That was November 2008. and up 248% from the final bottom in March 2009. And it goes on to talk about how if you add dividends in, it's over 300% for both of them. So I don't know when exactly this data is from. So obviously the market's super volatile at the moment. Those figures may fluctuate, but we'll just go with those percentages. So even after the recent market fall, you're still up over 200% in 10 years, no matter whether you bought on the first bottom or the second bottom, okay? If you add in dividends, obviously it's around 300%, all right? So if you're talking 300%, that's like 30% a year for 10 years. That's incredible, okay? You still have incredible gains no matter whether you bought the first bottom or the second bottom. And we're talking in terms of long-term value investing. If you're a trader, all right, and you're looking at charts, you're looking at the head and shoulders pattern, and you're looking at all these things to try and find a reversal, okay, obviously this is not for you, okay, because you're not holding long-term. But for long-term value investors, which is what I am and who I'm speaking to today, it really doesn't matter that much. And actually the better strategy would have been to dollar cost average your way in. So if you had bought the first bottom in 2008 and the second bottom in 2009, equal amounts in both, you would be up 230%, okay? Pretty much bang in the middle of that 212 versus 248%, okay? But you would have mitigated a lot of risk, because let's say you didn't buy in the first bottom, you then didn't buy in the second bottom thinking it's going to go lower, it's going to go lower, and then it started going up, you waited a few months and it was already above the first bottom and heading upwards, and you just missed your chance, and now you're only up 150%, okay, in 10 years. Oh, poor you, but it's still a high percentage. But anyway, the best way to mitigate risk is to dollar cost average your way in on the way down. And that's basically what I've been doing. I've bought in on every major fall the Dow Jones has had over the last month, except actually for last Monday. It just wasn't convenient for me to do any trading on Monday. I was busy with other stuff, but unfortunate, I know, but as a long-term value investor, it doesn't really matter. But anyway, I'll give you some examples of me buying in. So with Disney, I bought in on March 4th at $116 and on March 18th at $85, which means my cost basis for the stock is $104. The current price of it is $107, so we are already in profit with the market gains we've had in the last few days. And then when you consider this stock was trading at around $150 just, a couple of months ago, we have got a long way to go with this stock and a lot of money to be made in that growth, okay? And like Jeremy from Financial Education said, Mickey Mouse is not going away, all right? Disney is an institution. It would take a lot to, bankrupt that company. So let's move on to another one. My next one is Uber. I've bought in on 2 of the major down days this month, except for obviously last Monday, which was the biggest down day, although Uber stock actually was not, down that much on Monday. So I've bought in on, major down days for Uber, 3/12/2020 at $23 and 3/18/2020 at $14. And those I've bought, larger amounts of shares on those 2 days. Obviously, if you look further in the past, I have actually had a position in Uber for quite a long time. So my cost basis is a little bit higher with this. My cost basis is $27. Obviously, some people are like, man, you could have went all in at 14, man. Yeah, I could have lowered it more if I bought larger amounts. But, it is what it is. However, as of the recording of this video, Uber is already trading at $28. So I'm already in profit from my cost basis. And when you consider that it was trading at over $40 just, a couple of months ago, we have around 30% gain to go just to get back up to the level pre-financial crash. And then obviously, I do believe in this company for the long term. I think they are going to be very profitable in the future. So a long way to go, even further than that. So hopefully from that, you can see that dollar cost averaging your way in is, a more measured approach. Obviously, if you'd bought Uber at 14, you would have doubled your money now, made 100% return. I only do that kind of thing on very small amounts of money, in the hundreds rather than in the thousands. Because when I'm investing, say, several $1,000s in a company, I don't want to be just going off, yeah, if this goes up to, its previous price, I'll have doubled my money. Whoa-hey. I don't want to go for that much risk. And that brings me to the last section of this video. I want to give people a warning about buying beaten down companies, all right? So during the tech bubble of the year 2000, 2001, obviously the NASDAQ crashed at that time. It did not regain that high until 2015, okay? 15 years the NASDAQ took to recover. Now, obviously individual stocks on the NASDAQ did recover faster, but because there were so many bankruptcies, the overall stock market of the NASDAQ, the overall index of the NASDAQ took 15 years to recover. Many companies went bust during the tech bubble. Do you remember pets.com? Well, if you go to pets.com now, it redirects to PetSmart. That's because they bought the URL from pets.com, but it used to be an actual .com company that was selling pet food, pet toys, all that kind of stuff. They went bust when the tech bubble burst in the year 2000. So I'm just letting you know that some of the companies that have, incurred major hit to their stock price, some of them may go bust as well, all right? May go bankrupt. So if you want to hold on to your money, I do advise that you tread carefully here. I wouldn't just go and buy the airline that has suffered the most, okay? Because probably they have a lot of debt on their balance sheet, all right? What I would do is, and this is a Warren Buffett principle, I'll give you an example from Warren Buffett. In the 1950s, the insurance industry, I think it was the year 1950, the insurance industry had a particularly bad year. Warren Buffett went in and he looked at the company in the insurance industry which had the strongest prospects, which was Geico. And he went in, he put a load of money into Geico, and Geico has become an incredibly successful insurance company. Actually, Warren Buffett's company, Berkshire Hathaway, now completely owns Geico. But yeah, that was his strategy. You look at an industry that the entire industry has been beaten down, okay? So in this case, airlines, but you then go and find the strongest company within that industry that has the best chances of succeeding. Their stock price is depressed also because the entire industry has been depressed, but they are in a strong position to succeed. So in the airline industry, a lot of people say Delta is in the best financial shape out of the major 3 US airlines. I think that to be true. Obviously, if you're going to look at that, do your own research. Don't just listen to me. This is not financial advice, but that is the strategy that I would advocate. Look at an industry that has been beaten down, but then don't just go for the company that has dropped the most, fear of missing out, just like, oh my God, I could make so much money. Analyze their financials, look for the company that is in the strongest position within that industry. Airline industry, probably Delta out of the US airlines. That's my little bit of advice, which is not financial advice because I'm not a CPA. You shouldn't be listening to some random guy on the internet telling you what to do with your money. Go and do your own research. And if you're wondering what to do with your $1,200 check or any money that you have lying around, why not invest in the stock market? Because there are some bargains on the table. We have a deal with Webull. It's a great stock trading app. I much prefer it to Robinhood. I think it's way more advanced, although it still remains pretty user-friendly. We have a deal for you to get 2 free stocks by opening and funding a Webull account. And those stocks can be valued up to $1,000 or so, depending on your luck. So I wish you luck with that. If you are interested in Webull, you can click the link below to download the app, open an account, etc. It is one of my favorite stock trading apps, and obviously it is 0 commission as well, like Robinhood is. Thank you so much for watching, guys. Please subscribe if you're new, and we'll be giving you an update on those $1,200 checks when the House finally passes the bill, probably this Friday. Thanks so much, guys. We'll see you next time. Bye-bye.